We're jumping straight into Gemini Space Station today. Everyone is watching the price action, but the real story is its regulatory moat and institutional custody play amid massive post-IPO volatility.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Hit that subscribe and like button so we can keep simplifying the market for you.
Yeah, definitely hit subscribe because things are moving incredibly fast right now.
Fast is an understatement.
Right.
I mean, we really need to set the stage on what is actually happening with this specific equity. Because if you rewind the clock just, a few months back.
Right, to the IPO.
Exactly, to September 12, 2025. Gemini Space Station was literally the absolute talk of the town. I mean, they went public via IPO at $28 a share, and the market was just incredibly hungry for it.
Voracious.
Yeah. That initial demand pushed the opening price all the way up to $37.01.
Which is just a staggering debut. I mean, at that peak moment, Wall Street was valuing this entire operation at roughly $3.3 billion.
$3.3 billion.
Yeah. People were treating it like it was the next invincible titan of digital finance.
But, fast forward to today, March 5, 2026, and the picture is just entirely different. I mean, shares have completely cratered.
Oh, absolutely cratered.
They're sinking over 80% from those initial highs. We're currently seeing the stock fluctuate in this really depressed, tight channels somewhere between $6.67 and $8.87.
Yeah.
It is a breathtaking reversal in less than 6 months. So I have to ask, how does a company go from a $3 billion darling to a sub-$10 afterthought so quickly?
Well, when you see a drop that violent, you are looking at what we call a classic battleground stock.
Okay, a battleground stock.
Right. For you listening, think of a battleground stock like this historic, beautifully constructed mansion that's sitting on a highly coveted piece of land.
Great real estate.
Exactly. But last night, the mansion caught fire. Now, the flames put out, but nobody actually knows how much structural damage there is. So half the neighborhood is running away screaming, completely convinced the place is going to just collapse entirely.
They wouldn't touch it with a 10-foot pole.
Exactly. They won't touch it. That represents the fear side of the market right now.
And the other side.
The other side, the opportunists, they're standing right across the street with clipboards and calculators. They realize that the underlying land alone might actually be worth more than the current asking price of the burned-down property.
Right.
When fear reaches this kind of fever pitch, opportunistic value often hides right beneath the surface. I mean, people panic, and panic creates severe mispricing.
Which brings us perfectly to the bull case.
Yep, let's get into it.
Why might investors look at this literal wreckage and decide to start piling in? The core of that optimistic argument really rests on their potential for revenue growth. But more fundamentally, it rests on their ultimate competitive advantage.
The regulatory moat.
Exactly, the regulatory moat. Gemini Space Station hasn't just popped up overnight to capitalize on some fleeting trend. They have been a New York Department of Financial Services, or NYDFS, licensed trust company since 2015.
Right.
But let me push back here for just a second, because if I'm a retail investor, why should I care about a decade-old piece of paper from New York? I mean, couldn't a massive hedge fund just use a cheaper offshore exchange?
That is the million-dollar question, and the answer is absolutely not. We really need to translate what that NYDFS designation actually means.
Okay, break it down.
Being a licensed trust company in New York is not just some fancy certificate you frame and hang in the corporate lobby. It is an almost impenetrable barrier to entry.
How so?
Imagine you are trying to open a new nightclub, and the city tells you that before you can even pour your first drink, you need to hire 100 armed security guards, install a military-grade biometric scanning system, and prepay a $10 million insurance policy.
Wow. Most entrepreneurs are just going to walk away and open a coffee shop instead.
Precisely. And that is the NYDFS license. Because Gemini Space Station did that grueling, highly expensive work to get that license way back in 2015, they are legally permitted to offer true institutional-grade custody.
Okay, so that institutional distinction is the actual key here. We aren't talking about retail day traders moving $500 around on their phones while they wait in line for coffee.
Not at all. We are talking about the true heavy hitters of global finance. Hedge funds managing billions, multinational corporations allocating treasury reserves, sovereign wealth managers.
The big money.
The biggest money. And these entities cannot legally, functionally, or structurally risk using less regulated offshore platforms. They just can't wire $1 billion of client funds onto an exchange located in some jurisdiction where the regulatory status might change depending on the political mood of the day.
Right, their compliance departments would have an absolute heart attack.
Exactly. They need a fortress. And Gemini Space Station operates as that fortress.
So they get these massive institutions in the door for secure custody. But custody fees alone aren't going to justify a multi-billion-dollar valuation over the long term.
No, they won't.
So how do they keep those heavy hitters from eventually jumping ship for a slightly cheaper competitor once their assets are parked?
You just hit on the most crucial part of their business model. It's the ecosystem trap.
The ecosystem trap.
Yeah. Once an institution integrates with Gemini Space Station for secure storage, they inevitably start using all the other integrated services because the friction to go anywhere else is just too high.
Right.
They start utilizing their stablecoin issuance for quick liquidity, and they use their over-the-counter, or OTC, trading desks.
Let's pause on the OTC desks for a second. Why wouldn't a hedge fund just buy their assets on the open market like everyone else?
Because of a concept called slippage.
Slippage, right.
Yeah, so if a prominent fund wants to buy, say, $50 million worth of a digital asset.
Which is a massive order.
Right. Executing that on a public order book will cause the price to literally skyrocket while they are in the middle of buying it, meaning they get a terrible average price.
Ah, I see.
An OTC desk allows them to execute these sweeping block trades privately, locking in a set price without moving the broader market. And Gemini Space Station provides that seamlessly from the exact same place the assets are custodied.
That makes a lot of sense.
And furthermore, it's not just institutions. They have profound hardware partnerships, too. Look at their integration with Samsung wallets.
Right. And when your software is physically baked into the hardware architecture of one of the largest smartphone manufacturers on the planet,
It's massive.
ripping out your services to go to a competitor becomes a total logistical nightmare for the manufacturer.
It's the ultimate lock-in effect. You come initially for the regulatory safety of the custody, and you stay because untangling your entire operational infrastructure to move to another platform is just too expensive, too risky, and way too complicated. That is a textbook economic moat.
So we established they have this sweeping moat. Let's pivot to the financial health and valuation, because this is where the numbers get really surprising for a company that just went through a brutal post-IPO crash.
Very surprising.
If you look at their balance sheet right now, their market cap is sitting around $1.02 billion.
Right.
But their enterprise value is only $317 million.
Yeah.
We really need to simplify this because to the untrained eye, those are just two giant numbers.
Sure.
Why is the gap between those two figures the single most important part of the bullish financial argument?
It is the absolute cornerstone of the bull thesis. Let's break down market cap versus enterprise value with a real-world scenario.
Okay, let's hear it.
Imagine you are buying a local business, let's say a neighborhood bakery. The owner looks at you and says, I want $1 million for this entire operation.
Okay, $1 million.
That $1 million is the market cap. It's the sticker price for the equity of the business. So you agree, you hand over the $1 million, and you get the keys to the front door. But after the previous owner leaves, you walk into the back office, you open the floor safe, and you find $700,000 in cold, hard cash just sitting there.
And since I just bought the entire business, that cash belongs to me now.
You hit the nail on the head, you get to keep that cash. So effectively, what did the actual operations of that bakery cost you?
Well, $1 million out of pocket minus the $700,000 I just found.
Exactly, meaning the true operational cost to acquire that bakery was only $300,000. That lower number, the actual cost of the business after accounting for cash and debt, that is the enterprise value.
So in Gemini Space Station has a market cap of over $1 billion, but an enterprise value of only $317 million. It's screaming to the market that they have a mountainous pile of cash and highly liquid assets compared to very low net debt.
Spot on. And for a recent IPO, having that much liquidity and that little debt is incredibly rare.
Yeah, usually companies go public because they're bleeding.
Exactly. They go public precisely because they are desperate for cash to pay down crushing debt loads. Here, the low enterprise value provides a profound safety cushion.
And a significant portion of that safety cushion comes from their corporate treasury strategy, right? They hold Bitcoin directly on their balance sheet.
Yes, they do.
Which acts as a natural corporate hedge against the devaluation of traditional fiat currency. But I keep seeing this specific accounting metric thrown around by the bulls. Their multiple to net asset value, or MNAV, is sitting at 1.073 against their enterprise value.
Yeah, the MNAV.
Break that down for someone who doesn't read accounting textbooks for fun.
I'd be happy to. Basically, MNAV is a stress test metric. It tells you what would happen in a complete doomsday scenario.
Okay.
If you completely shut down Gemini Space Station today, fired everyone, sold off the desks, liquidated all their crypto and cash holdings, and paid off every single debt they owe.
Just a total fire sale.
Total fire sale.
Yep.
The physical and digital assets left over are worth almost exactly as much as what the market says the entire operating business is worth.
Wow. An MNAV near 1.0 means the market is essentially pricing in zero future growth. Investors are valuing the company strictly for the spare parts in its garage, completely ignoring the fact that it owns a world-class, fully functional engine.
And we are seeing that precise sentiment reflected by the analysts who track the sector closely. Despite the extreme volatility and the stock dropping 80%, the analyst firm Rosenblatt recently updated their models.
They did.
Now, to be clear, they did lower their price target significantly, bringing it down from $26 to $11.50.
Right.
However, they maintained a positive outlook and recommendation on the stock heading into 2026. Why is maintaining that positive sentiment so crucial when the price target was essentially cut in half?
Because a slashed price target is often just an analyst acknowledging the gravity of the current market reality. When a stock is trading around $8, leaving a $26 target on your report makes you look disconnected from reality.
You lose credibility. Exactly. But by maintaining that positive recommendation, Rosenblatt is signaling to the market that the underlying fundamental thesis, the regulatory moat and the cash cushion, is still entirely intact.
Yeah.
Furthermore, if you just do the basic math, a target of $11.50 from where it is currently trading implies a potential near-term upside of over 30%.
Which is massive.
That kind of upside is exactly why those opportunists with the calculators are circling the property.
Okay, so if I'm listening to this right now, I'm probably thinking, great, they have a regulatory fortress, they have a mountain of hidden cash, I should mortgage my house and buy this stock tomorrow.
Right.
Looking at the flip side, you don't lose 80% of your equity value just because the market is having a bad hair day.
Definitely not.
The bear case here is heavy, and it centers on some genuinely ugly price action and major internal upheavals. The elephant in the room is their profitability, or well, lack thereof.
Yeah, the lack of profitability is glaring.
Their financial losses are currently dramatically outpacing their ability to scale. We are looking at a price-to-earnings, or PE ratio, sitting at negative 1.63.
Which hurts.
But hold on, isn't burning cash completely normal for a young tech or crypto company? Why is the market punishing them so violently for doing what startups are supposed to do?
It is all about the macroeconomic environment. You are right that in a roaring zero interest rate bull market, investors will absolutely forgive cash burn if the user growth is explosive.
But they just want growth at all costs.
They will happily fund your losses for years. But in a volatile, uncertain market where capital is expensive, cash burn becomes terrifying.
Okay.
A negative PE of 1.63 simply means they are losing a substantial amount of money on every single outstanding share just to keep the lights on. The market is looking at that cash pile we praised earlier and wondering exactly how many months it will take for them to burn through it entirely.
And the market's terror seemed entirely validated by the brutal news that dropped in late February 2026.
Oh, the February announcement.
Yeah. Gemini Space Station announced they were slashing 25% of their global workforce. We also saw major executive departures, which always spooks institutional confidence.
Always.
But perhaps the most stunning part of that entire February announcement was their decision to execute major regional exits. They announced they were abruptly pulling operations out of the UK, out of Australia, and shockingly, completely out of the European Union.
I have to jump in here on that EU exit because that specific detail is a glaring, monumental contradiction that should make any investor hit the pause button.
Break that down.
We have to look at the timeline. In August 2025, right before their splashy IPO, they secured a highly coveted MiCA license in Malta.
MiCA?
Right. MiCA stands for Markets in Crypto Assets. It is the absolute gold standard for European regulation.
Why is that specific license such a big deal? I mean, Europe has tons of countries. Why does Malta matter?
Because Europe traditionally has a highly fragmented legal system.
Yeah.
If you wanted to operate in France, Germany, and Spain, you had to apply for 3 different incredibly complex licenses.
a bureaucratic nightmare.
Exactly. MiCA changed all that. Getting that license in Malta legally enabled a company to passport their services. It meant they could seamlessly operate across 27 different European countries with just one regulatory approval.
Wow.
It was a golden ticket to an entire continent of untapped institutional and retail wealth.
And yet, less than 7 months after securing this golden ticket, they are packing up their desks and abandoning the European Union entirely.
Yes.
Why would leadership throw away years of work and millions of dollars in compliance costs?
It tells you everything you need to know about how severe their internal cash crunch must be. They are operating in pure survival mode.
Pure survival.
Think of it like a medical emergency. A surgeon only amputates a limb to save the core of the body. Cutting out the entire European market and abandoning that MiCA license is a major corporate amputation.
That's a stark way to look at it.
It clearly signals that the ongoing expenses of operating in those heavily regulated international regions were just bleeding their cash reserves dry.
The internal number back that grim assessment up completely. We are looking at soaring operational costs across the board, with total expenses up 70% year over year.
70%, that's unsustainable.
And it's incredibly difficult to manage that kind of ballooning overhead when you are also dragging around lingering reputational baggage. They are still actively dealing with the shadow of past SEC issues and the broader fallout from the whole Genesis situation.
Yeah, that baggage is heavy.
Even though they are a heavily regulated entity now, bad headlines from the past create a drag on trust.
And trust is the only currency that actually matters in financial custody. If an asset manager at a major institution has to stand up and explain to their own board of directors why they are trusting billions of dollars to a platform that has recent, highly publicized SEC baggage,
That's a tough conversation.
it creates friction in the sales process. And friction is the ultimate enemy of revenue growth.
Add all of this internal turmoil to the broader macro threat hanging over the entire digital asset industry, the lingering crypto winter effect.
Right.
Even with these brutal cost cuts, the layoffs, and the regional amputations, Gemini Space Station's ultimate fate is still largely tethered to the broader crypto ecosystem.
Totally tethered.
If the price of Bitcoin takes a sustained dip, overall market trading demand weakens. Retail traders get bored and step away, institutions pause their capital deployment to wait for better entry points, and trading volumes completely dry up.
They vanish.
If that volume stays depressed for a prolonged period, the timeline for Gemini Space Station to recover and actually turn a profit could be severely, perhaps fatally delayed.
That is the core existential risk. You can spend billions to build the greatest, most technologically secure, heavily regulated toll bridge in the world, which is essentially what their institutional moat is.
Right.
But if nobody's driving their cars because there's a blizzard outside, you aren't collecting any tolls. The fixed costs of maintaining the guards and the infrastructure on that bridge remain, but the revenue vanishes.
So, given this intense tug-of-war between the sweeping regulatory mode on one side and the cash burn, executive departures, and international amputations on the other, what should a rational investor be watching right now?
We need actionable triggers.
Exactly. We need to look at specific, actionable triggers over the next 30 to 60 days as we navigate the spring of 2026. First up on the calendar are the May 2026 earnings.
That's going to be huge.
Now, there are no specific Q1 2026 dates confirmed by leadership yet, but May should bring the first full quarter earnings report since the IPO madness settled.
That earnings call is going to be the crucible for the stock's near-term future. We finally get to look under the hood and see the actual math behind those February layoffs.
Right.
Did amputating 25% of the staff actually stop the bleeding, or did it just hobble their ability to operate? More importantly, the consensus expectations for that report are going to depend heavily on overall crypto trading volumes throughout March and April.
Which have been volatile.
Exactly. If the market data shows that trading volumes were dead, Wall Street is going to price in a terrible report long before the CEO even opens his mouth.
And speaking of overall volumes and the broader market health, the second major catalyst we are watching is the Bitcoin floor. Specifically, the market is laser-focused on the $65,000 level for Bitcoin.
The magic number.
I hear that $65,000 number thrown around a lot by analysts. Why that specific price point? Why does that create a psychological safety net?
It goes beyond just human psychology. It is heavily tied to automated institutional trading algorithms.
Oh, the bots.
Exactly. 65,000 represents a historical resistance and support level. Institutional trading bots are literally programmed to view that level as a value zone. When the price hits that floor, the algorithms automatically execute buy orders, creating a literal programmatic safety net for the asset's price.
So it's baked into the code.
Yes. If Bitcoin can firmly stabilize and hold above that algorithmic floor, compliant exchanges like Gemini Space Station thrive. A solid floor signals to the broader market that the worst of the crypto winter fears might be overblown, and institutions will feel safe enough to start driving their capital back over that toll bridge.
We also have to zoom out and keep our eyes on the broader macro sector rotation. We are watching the potential for sweeping amounts of institutional capital to rotate out of safe haven assets and back into financial and crypto equities as risk assets begin to recover.
The great rotation.
This is partly tied to the broader global macro picture. For instance, the market is closely watching the resolution of ongoing Middle East tensions. But let's clarify this for our listeners. How does a geopolitical conflict halfway across the world affect a digital custody stock in New York?
It all comes down to the global risk premium. Think of the global risk premium like a giant thermostat for investor anxiety.
A thermostat, okay.
When geopolitical tensions flare up, the heat is turned up, investors get nervous, and they retreat to the cool, boring safety of U.S. government bonds. They don't want to take any chances.
Like to safety.
Exactly. But whenever major geopolitical tensions begin to stabilize or resolve, that thermostat cools down. The risk premium drops. And when that happens, massive asset managers take their money out of the freezer and aggressively put it back into high-growth, riskier assets like tech equities and digital currencies.
And Gemini Space Station is waiting for them.
Gemini Space Station is perfectly positioned on the shoreline to catch a tidal wave of that incoming liquidity.
Finally, you need to keep a close eye out for upcoming industry events. We are looking for any NASDAQ post-IPO investor updates or major keynote presentations at upcoming crypto conferences.
Those are critical right now.
Why do these seemingly standard PR events matter so much for a struggling stock?
Because when a company is this heavily beaten down by the market, management often uses these public, highly visible forums to offer fresh forward guidance, calm the turbulent waters, and aggressively try to regain control of their own narrative.
Control the story.
Right now, the market's narrative for them is shrinking and surviving. A strong, confident presentation from their leadership team could act as a sudden, unexpected catalyst to pivot that narrative back to moated and growing.
Let's give you the final lowdown on all of this so you can walk away with the big picture. Gemini Space Station right now is a textbook post-IPO capitulation story.
Textbook.
The stock has been absolutely hammered by the market. It's trading at severely depressed multiples compared to its actual cash value.
Right.
And management is aggressively slashing internal costs and amputating entire international divisions just to survive this season. But beneath that extremely ugly surface, its NYDFS licensed custody infrastructure remains entirely intact. That license makes it the premier, compliant crypto play for major institutions, assuming the broader digital asset market rebounds and Bitcoin holds its critical ground.
It is a high-stakes, nerve-wracking waiting game. The underlying value is clearly there. The regulatory moat is very real, but their internal execution over the next 2 quarters has to be absolutely flawless, or the cash burn will catch up to them.
Which leaves us with a final, slightly provocative thought for you to mull over as you watch this chart. We've talked extensively today about how incredibly valuable their institutional moat is.
Right.
But if the future of crypto adoption ends up being driven entirely by decentralized peer-to-peer retail networks that don't rely on centralized gatekeepers at all, will Gemini Space Station's massive institutional regulatory moat turn into a gilded cage?
That is the ultimate existential question for this entire sector of the industry.
Make sure to hit that subscribe button and stay tuned to the Easy Money Show for more market clarity as we keep watching this story unfold.